Hey everyone, welcome back to the channel. I'm Doug the Retirement Guide. Today we're going to break down the Russell 2000 Income ETF Showdown. This is going to be the NEOS Russell 2000 IWMI versus ProShares ITWO. We're going to take the top two ETFs. We're going to really, I believe, choose one true winner and which one's right for your portfolio. So we're going to break each one of them down, understand how they operate, what they do, because you got two funds virtually trying to do the same exact thing. They're trying to give you that income and growth from the Russell 2000. So let's do a dive into that. And before I do it, I got to do a shout out to all of our Patreon supporters and all of our YouTube members. Thank you so much for being a part of it and help supporting the channel. Important disclaimer, the content is for educational and entertainment purposes only. It's not financial advice, and the presenter is not a financial advisor. Investing involves risk. Income is never guaranteed. Past performance does not guarantee future results in any way. If you need help, always contact a financial licensed financial professional, as we are not. So I want to just give a fair shout out there to our Retirement Made Easy Living on Dividends coffee mug. This is really what supports the channel. $8.99 plus shipping. Real simple, easy to get. Use the QR code on the side. Go into the description down below. You can see the link right there. But basically, guys, we kind of put this together. I cannot believe how much support you guys have given us. We're almost done with our second full run of coffee mugs, ready to place our third order. Something simple, something unique, something different we thought we would try, and you guys seem to be loving it. So just want to put it out there, our quick ad on our coffee mug for only $8.99. We really appreciate the support, and if you don't be afraid, order one up. Makes for a great late Father's Day gift or anytime around anyone into retirement. So what are these funds trying to do? Well, both IWMI and ITWO are built around the Russell 2000. The Russell 2000 is the small cap section of the U.S. stock market. That means they are not the mega cap names like the Apple and the Microsoft, Nvidia, and Amazon. I always want to say this is kind of like the backbone of the stock market. These are the smaller companies, smaller caps that move fast when the economy is strong, but they can also be very volatile. It's very important for retirement investors because when all the small caps to a retirement income portfolio are adding potential growth, we also need to make sure we understand the full risk. So the goal with IWMI and ITWO is to take the Russell 2000 exposure, pair it with an option-based income strategy. That way investors can collect monthly income and still participate in that small cap market performance. But the way they do it is so different, and that different does create a matter. So let's first introduce IWMI, the NEOS Russell 2000 High Income Fund. Now, the strategy that they use, you're probably going to say is very familiar with what you run into with NEOS in the NASDAQ 100 and the S&P 500. This one uses an active small cap core. Its investments direct into the Russell 2000 exposure via an active managed portfolio to capture that small cap growth. It uses a strong tax efficiency and it has the upside participation. It's a flexible design that avoids selling away all the market gains, allowing for potential equity appreciation in bull markets. Now, what they use is a data-driven call strategy. Now, it's an actively managed option position using a combination of sold and purchased Russell 2000 index options. They buy back some of the upside along the calls via seeking participation when small caps rally hard rather than being capped at the strike price. Very unique way that they do that. When we pop the hood on this, and I'll start off with this, the fund is actively managed and it's a fund that seeks to generate income by investing in the Russell 2000 index while also employing a call option strategy. So when we take a look at the IWMI from NEOS, it's got $946 million in assets already. 0.68% expense ratio, which is about normal for the NEOS packages. 18.95 million shares outstanding, pays a dividend yield about 13.40% or $7.10 year to date. Now it does pay out monthly, and the fund, this is where it's really crazy. This fund is the 52-week high is $53.54. When it runs between at 53.04 and 53.28 is a daily range. Now we look at this and we see a lot of similarities to the action that we saw in the NASDAQ 100, we saw it in the S&P 500. We all had the drop off in April. We have that W here in the middle of June, and then really coming into an M frame in the category at the end of June. Now where are we going? This thing's almost at its top peak. So the small caps have actually done very, very well in today's economy. When we take a look at the performance so far, and I'll give you the total returns here. In year to date, they're at 17.32. 1 year, 35.26%. And since inception, 19.79. When we look at their top holdings, what they're really doing is they're buying the Vanguard Russell 2000 ETF, VTWO. And this is what they're doing and selling their call options on and buying accordingly. You can see their options down at the bottom. So realistically, they're not real owning the entire Russell. They're just buying an ETF. Now let's talk about ITWM, the ProShares Russell 2000. Now this one uses a different strategy. This is what we call a daily covered call strategy. So what they do in their daily call mechanism, 1 day to expiration, so it's called a 1 DTE. It combines long Russell 2000 exposure with a short call option that refreshes every trading day. It reduces the timing risk. It spreads the option process across many days rather than making one large monthly bet. So that's your first big difference between the two funds. The market tracking, it's designed to generate income while keeping total return closer to the underlying small cap market. Now, the structural complexity of all this, they're using a swap-based implementation. It does not write options directly. It uses swap agreements to gain exposure to those daily call strategies. It uses what we call derivatives. It gives you that risk profile. Investors are exposed to the counterpart's risk, swap tracking risk, and benchmark alignment issues. So the execution definitely is more complex. The daily refreshing process is more operational complexer than the traditional monthly covered call strategies. Now with that, we're looking at ProShares. This one came out in September of 2024. This is $190 million in assets. So both funds very, very well equipped. 0.55, a little lower expense ratio. 4.18 million shares. 7.26% yield, and at $3.33 over the past 12 months of payouts. We look at the fund right now. The top end is $47.03. The range has been $46.51 to $47.06, so it's really right at the top across the board. We look at the fund that both funds operate and show almost identical numbers across the board, but the growth factor of this fund has definitely been much stronger at 16.85 year to date. When we look under the hood of Russell, of the ProShares, we see a couple different things. I'll start off with the total returns. You see a higher total return rate, 23.66 year to date, 43.20 over 1 year, 23.18 year since inception. Now, what we also see, though, is look at they actually buy more and more of the funds of the Russell 2000 and then use that accordingly. Then they're also doing the covered call daily CBOE, or Russell 2000 daily covered call index. So they're using an index along with owning the index. Very unique system. You can see in the sectors that they have, realistically, other is 54%. But financials, industrial, healthcare, technology is very small into the category. So two totally different portfolios, two different ways of doing it. So let's go break down head-to-head comparison. Yield. IWMI, the NEOS, wins with that $7.10 over the past 12 months versus $3.39, giving you a higher yield of 13.40 to 7.26. So if you're really all just using it yield, this is the way you want to say, okay, the NEOS is the way to go. Now, when we take a look at the growth side of it, IWMI, the NEOS, won the yield, and they have a nice showing of 8.71 in year-to-date growth. But ITWO, the ProShares, comes in at 16.85%. So, like I showed you, these two funds use the same Russell 2000, but they both operate so much differently between the two. So if you're looking for income, okay, you have one area to go to. If you're looking for growth, you have another fund to look at. So it's really amazing how these two actually operate. Now, when we look at total return, now this is where it makes the big difference. I'm telling you, year to date and then 1 year total. This is where the ProShares really passes the finish line and flies forward. ITWO gives you a 23.66% year-to-date so far total return, with NEOS at 17.32. Not saying that's a bad fund. It's just you're getting more total return so far with the ProShares. When we look at 1 year, we're basically looking at an 8% difference between the two funds, 43 to 35. Now you take a look at right now, every angle that we look at this, okay? If we look at 1 month, if we look at year to date, we look at 1 year, we look at since inceptions, the two funds are designed to two different paths. And I really put it this way. The NEOS fund is designed for income first with growth second. And I really believe ProShares has really done this as growth first, income second. So it really depends on what you need, what you want, and how you want to play in your portfolio. Now, how do they handle the taxes? Now, this one's a little struggling, and I'm going to say it's a unique system. Now, I'm going to start with NEOS because I understand NEOS very, very strong. This is identical to what they use in QQI and SPYI. They use the 1256 sections, okay? They do those futures and those options through that. They get that 60-40 long-term play. So 60% of your distributions are classified as long-term capital, 40% are set up as short-term capitals. They then use a portion of those distributions may be required at ROC to help even reduce it even more. Okay, now I believe this fund is really good in all accounts, in the taxable accounts, Roth and traditional. Now, ProShares does use 1256, but it's not the front liner. This is where people get confused. They still have the option because they're selling the index. There's a lot of part of their stuff using that section 1256. But their big portion is actually on the ROC, that they use a larger portion of ROC, which is return of capital, than the NEOS package does. So I really put this, both of them use those 1256, both of them use a very tax efficient way. So I'm pleased both ways with these on taxes. So I can't really say one's better than the other. It's kind of like you're taking two paths to get to the same spot. So one does it maybe a little more efficiently, but the other one has worked very well. So I can't argue across the two on tax sides of it. Now let's take a look at the head-to-head scoreboard. For distribution yield, IWMI NEOS is really beating the competition at 13.4% versus ProShares only at 7.6%. Now after that, you can see the board's really going to change. Growth, NEOS comes in at 8.71, but ProShares comes in at 16.85. Total return, 35.26 to 43.20. Tax efficiencies, I got to put both of them do a very, very good job. So we put it at what we call high. Expense ratio 0.68 to 0.55. I don't know how you want to report this. I see these two funds. NEOS, if you want income, is a choice. ProShares, if you want growth with that total return, which is basically growth with a little bit of distributions, everything just looks much better on the ProShare side. Now, for me personally, I'm going to tell you this. For the retirement, I prefer the NEOS. Why? That higher yield of 13.40%, because I live off my dividends. You know, I'm living off my dividends. I need that income. So that big difference, about 6.5% difference, huge difference across the board. Now, it has good growth at 8.71, and it has a solid total return. So I want my income today and that little bit of potential growth, which is definitely, 8% is definitely a nicer number, than we're looking at what inflation now with 3.5%. I'm sitting here with 8%, so I'm happy with the growth side of it, and I'm very locked in that total return. So my whole thing is focus is on the retirement. Now that's not saying I'm right. What that's saying is, for me personally, this fits me well with IWMI. Now, if I'm looking to do some additional growth side of it, ITWO is very, very strong in what it does. Let me know your thoughts. Do you think I make the right choice? Would you be on the opposite page? Where does it all fit for you? I think the Russell 2000 definitely fits a portfolio very, very well. Leave a comment down below. I'd love to hear from you. Also, hit that like button. And don't forget about that coffee mug. They're going off the shelf quick.